I'm joined now by Hugh Sargent of River and Mercantile. He runs a 20-stock recovery portfolio on behalf of the Alliance Trust. Hugh, tell us a bit more about the investment style and philosophy behind the mandate.
At River and Mercantile, our investment approach is called PVT, short for potential, valuation and timing. Potential simply describes looking for companies that can grow their shareholder value at above average pace over the medium term. Valuation, the second factor that we exploit, is just a traditional approach to value, looking to pay 50p for a pound worth of medium-term intrinsic value. Timing, the third factor that we focus on, is recognizing that you can use timing tools to improve when you allocate capital to companies with potential and valuation. The timing tools that we use would be share price technicals. Is the share price heading in a positive direction? Profitability, our earnings revisions becoming positive, and also fundamental catalysts which help timing. So management becoming more focused on shareholder value, or perhaps new management coming in and adding that element of increased focus on shareholder value. So our philosophy is PVT, potential, valuation and timing. Now for Alliance Trust, we focus on recovery PVT stocks, recovery, potential, valuation and timing. Recovery simply describes companies which have strong underlying franchises, in the past have made attractive returns on capital, but where those returns are temporarily depressed, perhaps because they're exposed to an economic downturn or just a downturn in their own industry. Anyway, profits temporarily depressed creates a very significant valuation anomaly, because other investors will always focus on the short-term profitability. That would depress the share price, create a significant valuation anomaly for us to exploit. Recovery PVT, so recovery stocks, what we want is clear evidence of self-help, so that management have put in place a self-help program to improve their profitability, to recover their profitability, and that will allow the share price to close the significant valuation gap.
And how did that approach work in 2018?
2018 was a difficult year for our recovery PVT style. The market went through a period of fear. There was economic dislocation, the threat of trade wars, worries about the economic environment being less supportive. In that type of environment, other investors focused on safety first. I would describe it safety first type of investing. So the key factors that we look to exploit, which is recovery stocks, cheap stocks, i.e. attractively valued companies, and also multi-cap investing, looking down to mid and small cap type of stocks. Those factors actually struggled in that type of safety first environment. So it was a difficult year for us, 2018, but difficulty creates opportunities. So there are some fantastic PVT anomalies in our portfolio that we manage for the Alliance Trust. The difficulties last year made those stocks particularly attractive from a valuation perspective.
Well, what are two stocks that you've got really high hopes for in 2019?
A couple of our highest conviction stocks would be Baidu and Prada. Just quickly taking you through the Baidu investment case. I mean, this is actually a very large mega cap company. It's China's leading search engine, the Google of China. From our perspective, the franchise is a very strong one. But they're going through a period of significant reinvestment. So they're investing in video, they're investing in AI, they're investing in autonomous vehicles. So that very significant investment is temporarily depressing their profitability. The combination of that temporarily depressed profitability and other investors' fears about China has meant that Baidu is available at a very, very attractive valuation today. So if you strip out the value of its equity stakes in other internet digital franchises and look at its current free cash flow versus that valuation stripping out those investments, and the free cash flow yield today is well north of 10%, so a very attractive free cash flow yield. And this is a business that's still growing its top line by over 20% per annum, so very attractive starting valuation with material medium-term growth.
Now, that's one of the stocks. What's your second high conviction stock?
The second one was Prada. So this is obviously an iconic luxury brand. It's also been derated short term because of its exposure to China, to the Chinese consumer, who are spending a little less than they were 2 or 3 years ago. So that's led to a derating of the stock. But this is a business that's going through a multi-year change program, reinvigorating its brand, reinvigorating its product range, and also taking out costs. So that all that in combination should allow their margins to significantly improve over the next 2 to 3 years. Meanwhile, the starting valuation is really attractive versus its global peers. An attractive starting valuation, lots of potential as it delivers over the next 2 to 3 years. And again, we'd expect China-facing companies to actually see more positive sentiment develop over the next few years.
Now, you mentioned 2018 was a tough year for stock pickers, but which of your stocks did best?
I think our best performing stock over last year was Anglo American, so the global mining company. If you go back a few years, again, this was a classic recovery PVT stock. A few years ago, profitability was depressed as commodity prices had come under pressure. Anglo's went through a classic self-help program, cutting costs aggressively, selling off some non-core assets to improve their balance sheet, their financial sustainability. All this against a background over the last couple of years of a significantly improving market in terms of their commodity prices has allowed their profitability and cash flow to pick up really materially. At the beginning of last year, we saw that coming through really aggressively. That combined with an attractive starting valuation at the beginning of 2018 allowed the share price to perform very strongly last year.
There's a lot of top-down uncertainty out there at the moment. Does that make it a good time to be a stock picker?
Yeah, we think so. I mean, recent markets have reflected, I think, quite a lot of short-termism, and that's been encouraged by economic uncertainty, that short-term uncertainty, which has made life, I think, difficult in the short term for our type of stock picking, but it does create fantastic anomalies, fantastic stock picking opportunities, in particular from a recovery PVT perspective. So the portfolio that we run for Alliance Trust, if you look at the valuation characteristics, I mean, they are very compelling. It trades at only a small premium to book value. The earnings yield for the overall portfolio is almost 10%. The gross cash flow yield is in double-digit percentage yield. So the valuation characteristics are very supportive. Meanwhile, the 20 stocks that we have will be capable of delivering really strong profits and cash flow growth over the medium term. So attractive starting valuation, strong medium-term growth should really create significant absolute and relative returns for the portfolio that we run for Alliance Trust.
So in summary, you're quite optimistic for 2019.
I think that's a fair summary. Underlying economies are in a reasonable position. That short-term sentiment should pick up from low points. Meanwhile, the portfolio that we run for Alliance Trust is full of fantastic franchises on really exceptional valuations, and we think that should stand the portfolio in really good stead.
We have to leave it there. Hugh Sargent, thank you.
Thank you very much.